Today, we're going to dig into a real head-scratcher, a paradox right at the heart of Canadian retail. We're unpacking an analyst's report about one of the most well-known companies in the country, Loblaw. And let me tell you, it comes to a very surprising conclusion. I mean, seriously, if you live in Canada, Loblaw's brands are impossible to miss. Loblaw's, Shoppers Drug Mart, No Frills, you name it. The business seems to be firing on all cylinders. And yet, the financial report we're looking at today has a pretty shocking takeaway. It tells investors to avoid the stock. So, what gives?
The whole mystery really kicks off with this one chart from the report. See that line at the bottom? That's what the analyst thinks the company is actually worth. Its fair value. And all that orange space on top? Yeah, that's where the stock is actually trading. The story we're about to unpack is all about what's causing that massive gap.
All right, so to really get this paradox, we first have to give credit where it's due. We need to understand why so many people are bullish on Loblaw, because by a lot of measures, the company is an absolute powerhouse. It's doing a lot of things really, really well.
For starters, just look at this number. That's Loblaw's fourth quarter revenue growth. Now, in a tough economy, putting up double-digit growth like that is incredibly strong. It shows you that people are not just going to their stores, they're spending more money when they get there.
And the positive case just keeps building from there. We're talking about Canada's biggest retailer, with a footprint of around 2,500 stores. Their focus on value, places like No Frills and those super popular brands like President's Choice and No Name, is exactly what shoppers are looking for right now. And the engine behind it all? The PC Optimum program, a data collecting giant with 17 million members. That's huge.
And this quote from the analyst note pretty much confirms it. Their whole strategy is working. They're not just getting more people through the doors. Those shoppers are leaving with bigger and bigger baskets of groceries. So you look at all this, and on the surface, everything seems fantastic.
But here's where the story takes a really sharp turn. Because despite all that success, the analyst argues that Loblaw is missing one absolutely crucial ingredient for long-term success. And that brings us to a really important idea in investing. It's called an economic moat. The term was made famous by Warren Buffett, and the idea is pretty simple. It's some kind of lasting advantage a company has that protects its profits from competitors. Just like a real moat protects a castle from invaders.
And thinking of it as a castle's defense is the perfect way to picture it. Does the company have a deep, wide moat that's just too hard for rivals to cross? It could be a super powerful brand, a one-of-a-kind technology, or a massive cost advantage. So the billion-dollar question is, what kind of moat does Canada's biggest retailer have?
Well, according to this analysis, it has none. A no-moat rating. That is a pretty stunning assessment for a company of this size and influence. And it is the absolute dead center core of the argument against buying the stock. And of course, that's the question you're probably asking, right? It just seems impossible. They're the biggest player. They have these iconic brands. How could they possibly have no lasting competitive advantage? Well, the answer is found in the brutal, cutthroat reality of the Canadian grocery business. See, the report points out that for Canadian shoppers, the number one thing, the thing that matters most, is price. And with 3/4 of people living near a bunch of different grocery stores and 80% of us actively hunting for deals, there's just not much loyalty. You can switch from a Loblaw's to a Sobeys with zero effort, and people do it all the time to save a couple of bucks. This chart just drives that point home. Yeah, Loblaw is the leader with 27% of the market. But look at who they're up against. Sobeys, Metro, and of course the American giants Costco and Walmart. They're all powerful, aggressive companies fighting tooth and nail for that same price-sensitive customer. In a world like that, any advantage, like savings from being so big, it just gets passed on to us as lower prices to stay in the game. There's no moat to protect their profits. Okay, so what we've got is a well-run company in a brutally tough industry. And that brings us to the second half of this puzzle, the stock price itself. The really crucial point here is the difference between what the business is actually worth and what people are willing to pay for a piece of it. So to get this, we need to quickly talk about fair value. Basically, it's the analyst's best guess of a stock's true intrinsic worth, based on things like its future profits and cash flow. It's what the stock should be worth, without all the market hype. And for Loblaw, the difference is just massive. At the time of this report, people were paying over $67 for a share. But the analyst's deep dive calculation of its fundamental worth? Only $39. That is an enormous disconnect. This comparison really puts it all into perspective. Just look at the thermometer for Loblaw on the left. The price is way, way up in that red overvalued zone, so far from its fair value. Now, look at its competitor Metro on the right. It's also seen as a bit pricey, but that gap is so much smaller. The market has basically priced Loblaw for a level of perfection that its no-moat business might not be able to deliver.
So, what do you do with all this? You've got a great business, but it's in a tough industry and it has a very, very expensive stock. It all comes down to one final crystal clear verdict from the analyst.
And there it is. In a perfect grocery-themed punchline, the report concludes that investors should probably just walk on by. It's a powerful statement that cuts right through all the noise.
And this, right here, is the key takeaway. The analysis never says Loblaw is a bad company. In fact, it goes out of its way to show how well they're running their business. But it makes a critical distinction. A good company and a good investment are two totally different things. And the price you pay is what determines which one you're getting.
Which leaves us with the big question, one that goes way beyond just one company. It's a lesson for anyone looking at the markets. When does the price of greatness simply become too high to pay? It's the essential paradox of investing. Thanks for digging into this with us.